14 of 21 series are aligned with a stagflation mild macro regime this morning. That is a moderate level of agreement across the framework's core indicators. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In this configuration, the macro environment is defined mathematically by growth momentum decelerating at approximately -0.58 on our normalized scale, and inflation momentum accelerating at about +0.01. Those values capture the rate of change signature in the underlying growth and price composites, rather than a forecast of where the economy is headed. The coherent score sits in a moderate band, meaning a majority of the 21 series point to the same stagflationary backdrop, even though some remain out of sync. By our reading of comparable 3-month windows, regimes with a confirmation score in this range have persisted in roughly 41% of those historical cases, with the most frequently observed next state being an acceleration regime, where both growth and inflation momentum strengthen together, 3-6. Compared to last week's reading, confirmation has remained at 14 aligned series, suggesting that the underlying configuration has been relatively stable, rather than swinging into a different regime. Historically, environments like this have felt, in price terms, like periods where real return erosion is gradual and dispersion across sectors and regions increases. A record of past behavior, not a statement about what happens next. 9. Let's walk through 4 signals that sit inside this backdrop. First, Treasury yields. The 10-year yield is trading below recent peaks, while the curve between the 10-year and 2-year notes has steepened modestly, and the math engine marks the yield configuration as green momentum, defined as positive rate of change with readings in the stronger half of the 2-year range. Participants watch this because the combination of level and slope summarizes how the bond market is internalizing growth and inflation together. The question it raises is whether that current cost of capital aligns with how much duration and rate risk institutions are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with firmer inflation readings and mixed real growth data over the subsequent 1 to 3 quarters, an observation under our methodology, not a forecast. What would challenge this read is a decisive move in yields back toward prior lows, or a reflattening of the curve that undermines the green characterization. Second, labor. Non-farm payrolls and broader employment indicators have softened on a trend basis, enough for the engine to tag labor momentum as red, negative rate of change, with readings in the weaker half of their recent range. Markets care deeply about this because payrolls anchor income, consumption, and credit quality. The question this raises is whether current equity and credit pricing already embeds that softer hiring path, or still leans on more resilient assumptions. In our framework's reading of comparable periods, this roughly coincided with increased dispersion between cyclical and defensive sectors over the following several months, a record of how prior episodes behaved, not a roadmap. What would challenge this interpretation is a sustained rebound in hiring, or a drop in jobless claims that pulls the labor composite back toward neutral. Third, credit. High-yield credit spreads, the extra yield investors demand to hold lower-rated corporate bonds, have widened, and the math engine flags credit as red momentum under our definitions. Participants focus on this because spreads distill a wide range of risk perceptions: default anxiety, liquidity conditions, and institutional appetite for taking on corporate risk. The question it surfaces is whether current spread levels feel consistent with each allocator's tolerance for potential credit stress, and how that fits with their broader risk posture. In our framework's reading of comparable periods, this roughly coincided with more cautious behavior in lower quality credits within a 1 to 3 month window. Again, an observation under our methodology, not a forecast. What would challenge this read is a sustained tightening of spreads that brings the composite back into yellow or green territory. Fourth, sector and commodity behavior. Technology, industrials, and materials have rolled over, while energy, healthcare, utilities, and real estate have been firm, and crude oil prices have accelerated higher. The engine reads that mix as green momentum for defensives and energy, red for parts of growth and cyclicals. Markets watch this pattern because it translates the macro backdrop into actual leadership, and laggard lists across equity sectors and real assets. The question it raises is how comfortable participants are with their exposure to long-duration growth versus cash flow-heavy, real asset sectors in a mild stagflation configuration. In our framework's reading of comparable periods, this roughly coincided with continued sector dispersion and a tilt toward real assets over several weeks, a record of past market behavior, not a forecast. A challenge to this read would be a decisive rotation back into growth sectors alongside a cooling in crude prices. Two conditional triggers sit on the map today. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Under a stagflation mild regime, that kind of yield move would mathematically strengthen the case for a transition into an acceleration-style environment where inflation and growth momentum both run hotter, though that framing remains an observation only. If the Fear and Greed Index drops below 15 and holds for 5 sessions in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions. Again, a record of past behavior, not forward guidance. In a setting like today's, such a sentiment shift would mark a more stressed regime backdrop in the model, even as the engine continues to observe rather than infer motives. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. The framing is intentionally potential, educational. It describes how the math behaves, not what any individual should do. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.